In this week's video, we'll review numerous historical cases to help us answer the question, is the bull market dead and buried? In the slides that follow, we'll be reviewing 13 historical stock market cases, periods with ugly tapes, ugly candlesticks, and concerning we are in big trouble rollover looks. In each case, the 200-day moving average was either rolling over or in jeopardy of rolling over. And in each case, we have numerous trading sessions marked by heavy selling pressure. If you're not familiar with candlesticks, this is what heavy selling pressure looks like. This is buying conviction or buying pressure here. In this case, a lot of gut-wrenching and nerve-wracking days, gaps down here. This is a gap. This is a gap. 200-day moving average rolling over, a low, and then a retest of a low. These candles do not look very confident. Similar situation in this case. Ugly candles, heavy selling pressure, a low, and then what appears to be a retest of a low, and a very, very concerning looking candlestick making a new low with the 200-day moving average rolling over. Two more cases. Heavy, heavy selling pressure day after day after day. 200-day moving average rolling over what appears to be a failed attempt at reclaiming the 200. Another ugly setup here. Price below a downward sloping 200-day moving average. A low, what appears to be a retest of the low, with heavy selling pressure near the low. Similar themes over and over again. Heavy selling pressure, gaps in both directions, a low, a retest of a low, and candlesticks that do not inspire confidence. Everything I just said applies to this chart here. Heavy, heavy selling pressure near the retest of the initial low. Two more cases. In this case, stock charts didn't have candlestick data, so these are just high-low close bars. Hard to say this is a confidence-inspiring look. This is a much lower low relative to this low. Heavy selling pressure in the 200-day rolling over. This is an ugly-looking downtrend. Look how many red high-low close bars that we have here. Once again, they don't have candlestick data for this period. Price well below a 200-day moving average that's flattish and rolling over. Numerous red days near the low. Similar themes here. Tons of selling pressure. Big red candles, a rally attempt, and what appears to be a retest. Heavy, heavy selling pressure, price below a downward sloping 200-day moving average, a low and what appears to be a retest of the low. 4 out of the last 5 candlesticks look terrible. There's 3 things we can say about this chart. Ugly, ugly, and ugly. Case number 13, gap down, heavy selling pressure through a 200-day moving average that looks like it's rolling over. It's pretty fair to say that if we were experiencing all of this in real time, it would be very, very easy in each case to say we know what's going to happen. The market's going to move in this direction. It's going to move in this direction. It's going to move in this direction. We've got a new bear market. This time we'll walk through the same examples, except we will show what happens next. First case, February 11th, 2016. Second case, October 3rd, 2011. It doesn't feel good in the present day. I can assure you it didn't feel good here, and it didn't feel good here. In the 2011 case, I can assure you there were numerous fundamental things to be concerned about. We don't even have to look at the history books. How do we know that? Look at the candles. Markets don't drop in this fashion unless there are serious concerns. So let's flip forward and see what happened after this candle here and this candle here. The answer is in both cases, from the ugly looking setup that's down here and down here, really good things happened for a long period of time, and really good things happened for a long period of time. This and this came from this and this. Next cases. July 2nd, 2010. Look at the selling pressure here. No buying conviction at all. This market is plummeting and moving in one direction. Heavy selling pressure, heavy selling pressure, heavy selling pressure. This looks like it's going to be a failed retest of the low. What happened after 1, 2, 3, 4, 5 ugly candlesticks? What happened after 1, 2, 3, 4 out of the last 5 days are ugly? Let's fast forward. From this low here, the gain was 33%. This case is November 22nd, 2000. In this case, from the ugly formation, really bad things did happen, telling us to keep an open mind about all outcomes in the present day. From this setup here, we had wildly bullish outcomes. From a very, very similar and concerning setup, we had wildly bearish outcomes. This chart is dated November 22nd, 2000. From this point here and this point here, radically different things happened. How about these cases? Heavy selling pressure, ugly candlesticks on the retest. Heavy selling pressure over here, heavy selling pressure over here, somewhat of a retest look with a horrible looking candlestick. This case on the left side is the present day, November 23rd, 2018. And if you flip through these charts or review this video with your pause button, it is very, very difficult to say that this chart here looks materially different from any one of these charts. All of these look similar. This is the present day here, November 23rd, 2018. Present day, ugly setup. What happened next in 1994? From this candle here, this is what happened next. Really good things happened for a long period of time. The market recaptured downward sloping 200-day moving average and recovered after what appeared to be a disastrous retest of this low. Two cases here, both ugly, different outcomes. January 17th, 2008, July 24th, 1984. Let's fast forward. From this point and this point, radically different things happened. From this point here, this low here, the S&P 500 lost an additional 50%. Ugly look. Ugly look. You can make the case this is even uglier. From this point here, which is right here, from that low to this high, the S&P 500 gained 126% and rallied for several years. Look at the ratio of red high-low close bars to black high-low close bars. Not many up days in here. This is a one-sided market. A one-sided market, a one-sided market. The last three candlesticks here look very, very ugly. What happened next from this point here and this point here? In this case, really good things happened. A 40% gain, a rocket move over several months, recaptured the 200-day moving average. In this case, a 58% gain from the low in 1990 into the peak in 1993. We're showing multiple cases from different points in history for a reason. Really bad things can happen from ugly-looking setups. And really good things can happen sometimes from ugly-looking setups. Ugly, really ugly. What happened from this point here and this point here? From that low, the market eventually gained 65%, telling us here, when we have this really concerning look, and this really concerning look, there really was no reason to be patient here or here in terms of the shorter term data that we had in hand. But in these cases, patience was rewarded in a big, big way. In our last case, October 22nd, 1979, 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 out of the last 11 sessions, ugly. What happened next? Even in the context of this ugly setup, the market rallied 15% in a matter of months, recaptured the 200-day moving average, and retested it. Thus, we know from similar setups, this is similar, we can get radically different outcomes. How can that help us in the present day? Let's zoom in on Friday, November 23rd, 2018. This is an attempt here at making a low. We have constructive candles, a handful of them, off the low. So far, we have a very, very ugly retest setup. But that's not materially different from many of the setups that we just reviewed. In some cases, really good things happened, and in a handful of cases, really bad things happened. So in the present day, in our situation and under our approach, it makes sense to try to discern whether this retest is going to pass or fail. Thus far, we've remained above this low. And as we know from many historical cases, dropping below this low doesn't necessarily mean we're dead in the water. You can review many of those 13 cases where the market exceeded this low and then righted itself and really good things happened. We have hard data that says some of this is constructive and looks like prior lows. This is in the to be determined category. Right, an excellent table from Charlie at Pension Partners. Here is Charlie's Twitter handle where my cursor is here. You can follow him on Twitter. Point of the exercise. A typical year sees a drawdown, the median drawdown, of 13% from a high to a low intra-year. So let's take Charlie's table and see where we stand in the present day, in this case as of November 21st. So a 13% drawdown from the previous high would be this line here. Well, thus far, we really don't even look like a typical year. Here's the close here on November 21st. I can assure you that in every single one of these cases, it felt miserable and abnormal. But so far, what we've seen is not particularly abnormal for a calendar year in the stock market. Remember last week we covered the handful of MACD cases where we had a bearish cross, but soon after that, good things happened. So let's take the data from that table and apply it to the present day chart and see where we stand. For those cases, the median closing low would be this pink line here, which is very, very similar to the low that we've already experienced. And the median MACD intraday low for those cases is this pink line here. Once again, the present day, the close on November 21st and this low really don't seem to be out of line relative to these cases we covered last week. You may also remember there's a short takes post dated October 30th, 2018. You can find it by Googling this title here and our last name Shavako. In that post, we did an analysis of a Wall Street Journal table, the top 10 S&P 500 drawdowns since 1953, performance 35 days after the peak. And you can see the September 2018 case is in here. So these other cases here are similar to our present day woodshed case. So what can we learn? This post contains this table. If we apply this table and these figures to the present day, we can see that we could fall from here all the way down to here or all the way down to here. It would be similar to where the lows were made in these cases. So in all of these cases here, in the MACD cases and the Wall Street Journal cases, and the max drawdown cases, all of these lines represent areas where the market bottomed, telling us if we match these cases, and typically we're looking at median numbers here, so the typical case, patience down all the way down to here, could see a low and then a reversal. How does all of this apply to our specific strategy and approach? And why do we want to have a specific, disciplined, and logical exit strategy? If we feel like the market could bounce at any one of these levels and make a low, why don't we just leave it alone? Well, since a picture is worth 1,000 words, let's ask this question. What would a repeat of the dot-com bust or the financial crisis look like in 2018? So if we put these declines from these highs here, how much uglier could it get relative to these lines? And we'll warn you in advance, these pictures may be disturbing. What would the dot-com bust look like on this chart, assuming this is our peak? This is the answer. And this is why it's prudent to have a step-out exit strategy. For conversation's sake, let's say we stepped out here and we're totally out of the market here. Would we add value relative to a drop like this? The answer is absolutely positively yes. If we were able to be patient or only have one or two step outs, and the market finds a low as it did in these historical cases somewhere in this range, and then rallies, would we add value? The answer is absolutely positively yes. So our original question said, what would the dot-com bust and the financial crisis look like on this chart? Well, unbelievably, you can't see the financial crisis decline on this chart, but you can see it on this chart. Once again, emphasizing the concept that it's not too late in the present day to have an exit strategy relative to the type of drawdowns we want to avoid. Many of these types of drawdowns we're willing to tolerate. Why? As we noted earlier, these are areas where these typical markets found a low and then rallied. After the low was made in the Wall Street Journal cases, what was the typical rally or the reward for trying to be patient during the drawdown? The Wall Street Journal cases are this line and this line, and the answer is patience was rewarded in a big way. After the lows, the median gain over the next 2 years was almost 35%, which puts this type of drawdown, or even a larger drawdown, into some historical perspective. Similar situation if we look in the MACD cases. After the market found a bottom, following a bearish monthly MACD cross, in the handful of cases that we looked at last week, the median gain from the low for a patient investor was 35.18% over the next 2 years. This is the case for trying to be patient. This ugly-looking setup here is the case for trying to be patient. Because from this point here, good things happen for a long period of time. But we've also shown that from a similar and ugly setup, this setup here is similar to the present day, really bad things can happen. From that low, the S&P 500 lost an additional 50%. We've just shown that it's very, very difficult to discern between this type of outcome, this type of outcome, and this type of outcome, and this type of outcome. Which is why we always talk about maximum flexibility. If we keep that flexible, unbiased, and open mind, we can be open to everything from wildly bullish outcomes to wildly bearish outcomes. And this visual here should give clients some excellent support to the general topics that we've covered in the past about stepping out in an incremental fashion. If we stepped out here hypothetically and here hypothetically, and then the market rallied, no problem. But we have to have an exit strategy, because if this morphs into something like this or this, we want to be out somewhere in here, all the way out. There is no perfect way to do this under our approach and for our time frame. This acknowledges that it's very, very, very difficult to understand what tomorrow will look like based solely on the look of the charts today. I can guarantee you all 13 of these cases, it didn't feel good to be in the market. There were red screens all over the place. There were concerning technicals, just as we have concerning technicals in the present day. And every single one of these cases has concerning fundamentals. Markets don't drop like this without good fundamental concerns backing it. And the same can be said for every case. And in every single one of these cases, at some point, whether or not we went into a bear market, there was talk of a new bear market. Given all of these bullet points and how bad it would feel to be at this point, this point, this point, this point, this point, so on and so on out to this point, it would be very, very difficult to comprehend that from these chart patterns, these exact days, if we look at all 13 cases, the average gain from this point, this point, this point, same thing can be said for all of them, from the date shown, the average gain, roughly 58%, quite a bit different than the two bear market cases. The average loss, roughly an additional 46%. We've already had a loss here. This is the additional loss from these points. Even though in every single case it feels bad, and these bullet points apply to every single case, look how different the outcomes are in the two bearish cases and the remaining bullish cases. Very, very hard to believe that out of 10 of these charts, because 2 of them are bearish and 1 of them is the present day, 10 of these charts produced an average gain of 80% from the low. And a logical question might be, if you're trying to be patient for these cases, can't you just be patient for this case and this case? The answer is you can be, and that's a personal choice. Number one, it's very, very difficult to stick with the system from point A to point B. At some point, you're human, you'll probably sell over here. But even if you were able to hold, in the S&P 500 index case, just to get back to where it was here, in this case, from the peak here in the year 2000 to the get back to where I was before period, it took 2,757 days, which equates to more than 7.5 years. Do you want your retirement plan to go nowhere between age 50 and 57, hypothetically? Point A, 50% loss from peak to trough, and we get the point B here, just a horizontal line. Similar situation in the financial crisis. Point A, 57% drop in the S&P 500 from peak to trough. It took over 2,000 days or 5.5 years to get back to the same level. We get these questions a lot, so we have to cover this topic from time to time. What about the tariffs, trade, the Fed interest rates, concerns about global growth, or countless other concerns. There is not one fundamental question that you can think of that has not been considered by the markets. All of this is why the present day chart in November of 2018 looks like this. The market is absolutely positively concerned about some things. The temptation is to start trying to forecast outcomes and market reactions. Experience says that's almost impossible. For example, let's say we correctly forecast that the Fed is going to raise interest rates but change their guidance and their language to something like we're data dependent. Very, very difficult to try to gauge the market reaction. You could make the case that if they raise rates, we're going to tank. You could make the case if they back off on future rate increases or say they're data dependent and change their language after raising rates, that the market could go up like a rocket. The same can be said for anything that we can think of, and there's numerous permutations and combinations of possible favorable and unfavorable outcomes and market reactions, making it next to impossible to forecast the outcomes and correctly forecast the market's reaction. We're better off just taking it day by day, understanding the real world is numerous shades of gray, yellow, and orange. Said several weeks ago that it could take a long, long time to understand about this retest. The jury is still out here. We're basically sitting on this line. November 21st, 2018. Resistance, resistance, resistance. What once acted as resistance may now act as support. The jury is out. You get a big move in this direction, big move in this direction, and before that, all kinds of head fakes, false breakdowns, moves above and below. Maximum flexibility. What about this question? Nothing's worked well in 2018. Here's an article, December 28, 2015. The year nothing worked. Stocks, bonds, cash go nowhere. Harder markets, 2015, are typically followed by easier markets. 57% gain from the low in 2016, several weeks after this article was written, to the high on January 26, 2018. Same can be said for 1994. Harder markets, where stocks didn't do well and bonds got massacred, are often followed by easier markets. 1994, harder. 95 into the year 2000, easier. October 8, 2018, resistance, 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 a bullish breakout, S&P 500 relative to the 10-year Treasury bond price. Covered this in the past. This is a much more constructive look than even this constructive look, where good things happen for a long period of time. This is a quarterly chart. This is the end of the last quarter. September 28th was the last day of the month. This is the chart that matters, the end of the quarter. This is the only one that goes into the history books. Still holding the breakout, haven't lost this or this. Even if we fast forward to November 23rd, haven't lost the breakout, haven't lost this constructive look relative to even this constructive look. Helps us keep an open mind. But the markets looked horrible recently. That's true, but that's not particularly surprising. October 30th, short takes. Basically said it's not uncommon for the market to come back and retest the prior low. Not uncommon to come back, that was written here, to retest the prior low. Have no idea if it's going to pass or fail. We'll learn something either way. And the cases that we've covered today unequivocally tell us that the bias that we have in terms of extrapolating this chart and extrapolating the problems of the day into the future could make it very, very difficult to adjust if the news cycle changes in the present day. Why do some of these ugly charts, in fact 10 of them, go from a very ugly and concerning profile where we had all of these bullet points? How do they morph into better charts? Well, the answer is simple. Something changes in the news cycle. Something that was bothering the market here changes, allowing the market to rally. Once again, emphasizing we can't extrapolate the chart or the problems of the day indefinitely into the future. At some point, something will change. We have no idea whether that change will come in the next 6 weeks and we'll get something like this, or that change won't materialize for quite some time and we're going to get something like this or this. This is the look of the chart November 23rd. We'll learn something either way. This is the second line of possible defense chart that we posted on Short Takes, telling us that there are still logical areas of possible support below price as of November 23rd. Right now, and this is subject to change, we have a higher low relative to this low, a higher low relative to this low, and a higher low relative to this low. If nothing changes in the news cycle, it's very, very possible that all of these lows will be taken out. As the charts have shown in this video, it's also possible that something is going to change, and the market could rally in a surprising manner. That's all to be determined. Our plan accounts for, and we must be able to answer these two extremely important questions. What happens if the present-day ugly chart morphs into something more constructive and the stock market tacks on 35% over the next 2 years? How will we handle that? Our plan must also account for what happens if this ugly look here, concerning look, morphs into something like this or this. And the only way that we can properly execute going forward is to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.